A real engineer builds bridges. A financial engineer builds dreams. And, when those dreams turn out to be nightmares, other people pay for it.
Welcome to Reconstruction. Our society is built on the idea of trust. Our loyalty in the government, corporations, and capitalism might be in decline, but we still continue to hold some sense of trust in the mechanisms that make our society continue to move forward. A sense of this trust lies in the belief that there are those in society who have an understanding of what they are doing. Whether it's blind faith in the system, where we constantly fear our livelihoods can become disrupted at any moment, or whether we truly believe in these institutions. Finance. Finance is the driving force to making our market-based society exist. To go to college, to open a business, to buy a house, most people need to turn to a bank that can provide them with a loan. The bank takes a fee or percentage of interest from the loan and then uses this money, reinvesting into other loans, expanding its services while also creating businesses, educators, and employment opportunities. It's the basic foundation for society to function and grow. Finance today, however, serves another purpose, as it has expanded itself into the economy, taking a larger role in political and ideological messaging, and shrinking its investment in the public. Increasing from making only up 2.8% of GDP in the 1950s to 9% today. To quote Benjamin Landy of the Century Foundation, to give these numbers some context, consider that 9% of US GDP last year was about $1.4 trillion, an unprecedented windfall for America's capitalist class. What does society get in return? Or in other words, what does the finance industry produce? And this is a key question to ask when trying to figure out what role finance plays and how that benefits society at large. It has grown beyond its partnership with banks, hedge funds, and investments and financial groups to being utilized today by successful companies like Apple, a billion-dollar company who borrows money in order to buy back their stock, inflating the value. The practice of stock repurchasing causes severe damage to the progress of society, but as corporations feel the pressure to continually be growing their profits, they turn to these forms of investments. Thinking in the short term, they have little motivation to reinvest their revenues back into their company. Without the investment into expanding their labor force, layoffs and unemployment grow as good-paying jobs begin to disappear. The lack of funding into research and development forces companies to merge and gobble up other competition, buying patents, reducing creativity, and slowing technological growth. Competition becomes more monopolized, innovation disappears, and income inequality grows. As the economic journal MarketWatch states, quote, "Buyback activity has now become the rule rather than the exception, and Wall Street agrees with this practice by investing more into the companies that repurchase their stocks as opposed to those companies that don't. The purpose is to extract more profit in return for less investment in production." But if the purpose of finance is to expand the economy with the expansion of labor, business, and employment, we should ask ourselves, for what group is finance working for? An article from the San Diego Tribune in 2015 reported on the lack of loans going to small businesses. According to the Federal Reserve, shortly after the Great Recession, there was a couple years of loose lending from U.S. banks to smaller companies. But more recently, these banks have been tightening their lending. This is occurring at a time when the banks are able to take out loans from the Federal Reserve at near zero level interest rates. As the Tribune goes on to say that the banks have shifted who they are lending to, quote, "Such movement in standards has shifted opportunities for expansion to larger competitors. From the last quarter of 2010 through the quarter of 2015, the share of loans going to California small businesses shrank from 23% to 15.4%. In her book, Makers and Takers, Rana Foroohar brings attention to the fact that finance has created an economy of takers by taking advantage of the makers.
What market capitalism was set up to do, in the most fundamental sense, Adam Smith's idea. You take everybody's savings and you funnel it through financial institutions into new businesses, which hire people and grow the economy. I mean, that's how it's supposed to work. But if you look at the numbers now, that's been changing over the last 40 years. So today, there's some really deep academic research that shows that about only 15% of money flowing out of financial institutions ends up as new business investment. The rest of it is basically in a closed loop of trading of existing assets.
She focuses on the negative impacts finance has had in the last 40 years, spraying itself from its usually controlled market of investment in financial transactions between corporations to the creation of risky products and putting the potential fallout on the backs of the public. Foroohar talks about how pharmaceutical companies who have relied on financial transactions has in some cases stunted their research. as a select group of companies continue to dominate the market, they usually merge with new competitors, patenting their ideas, thus forgoing their own research and development and preventing new medical innovation. Most will remember the headlines a couple years ago when a hedge fund group ran by Martin Shkreli caused controversy after he bought a life-saving drug and jacked up the price by 5,500%. Although this incident received a lot of attention, mostly due to the complete arrogance of Shkreli, the price was eventually lowered. But it's important to note that the industry is littered with this type of behavior. A chief scientific officer and CEO from a biotech firm in Cambridge, when being asked what influence finance had on their research, he responded, quote, "Influence. Finance drives our research agenda," end quote. Or consider that more than 150,000 jobs were lost between 2008 and 2013, mostly in research and development. In an article from BillMoores.com, writer Lynn Stewart Paramore wrote, quote, "An EPI, Economic Policy Institute study, finds that 401k plans have also made regular people more vulnerable to shocks in the stock and housing markets and other economic trends. And if you're young, a minority, female, or single, you've got extra worries," end quote. As corporations begin to shift from pensions to 401ks, it's put more people's retirements and savings onto the financial market. While those who either through luck or having enough cash to utilize can make a nice return on their investment, a majority of retirees who rely on 401ks will not be properly prepared for when they retire. The instability of the market and the high fees that investors will demand in order to organize your 401k correctly take money away that would otherwise have gone to retirement funds in the past. John Boyle, founder of the Vanguard Group, estimates that our expanded financial system might be sucking up 60% of returns that ordinary retirement savers could otherwise earn on their money. And if you are not properly participating by investing in the market, taking on the risk, your 401k will not be sufficient when you retire. The CBO reported that Americans had lost $2 trillion of their retirement due to the Great Recession. This is money that will most likely never be recovered. Ford's contributor Richard Eisenberg discussed how more people have been taking more money out of their 401ks in order to supplement them in times of financial emergencies. Eisenberg refers to a report by Hello Wallet, which talked about the increased number of employees pulling from their 401k accounts early, sacrificing their retirement to pay for financial emergencies like family and medical. And while the report suggests that many of those who have taken from their 401k should set up an emergency fund, as Eisenberg notes himself, quote, "Not surprisingly, lower income employees are the most likely to pull money out of their 401ks, since they're the ones in greatest danger of needing cash for an emergency." The salaries for those in finance have exploded to record highs, while the average wage for workers had barely risen above the 1960s levels when accounting for inflation. According to a Pew Research report, income inequality is the highest it's been since 1928, the year before the Great Depression. The Federal Reserve's Survey of Consumer Finance reported that for 2013, the top 3% rose from 44.8% in 1989 to 51.8% in 2007 and 54.4% in 2013, while the share held by the bottom 90% fell from 33.2% in 1989 to 24.7% in 2013. Or consider the findings from the Economic Policy Institute stating, from 1978 to 2013, CEO compensation, inflation adjusted, increased 937%, a rise more than double the stock market growth, and sustainability greater than the painfully slow 10.2% growth in the typical workers' compensation over the same period. The CEO to worker compensation ratio was 20 to 1 in 1965, 29.9 to 1 in 1978, and grew to 122.6 to 1 in 1995 and peaked at 383.4 to 1 in 2000. It was roughly about 295.9 to 1 in 2013, far higher than it was in the 1960s, 70s, 80s, or even 90s. And if Facebook, which the EPI excludes from its data due to its outlier high compensation numbers, were included in the sample, the average CEO pay was $24.8 million in 2013, and the CEO to worker compensation ratio was 510.7 to 1. Keep in mind, this is a company that makes money by selling our information to advertisers. It's important to highlight the fact that the increase in CEO compensation was not through their salaries so much as through the increase in stock options and bonuses offered to them. And it is because of a larger portion of their salary transferred to the stock market, which was presumed to have a positive impact on the growth of the companies while providing a nice return for investors, the opposite happened. In her book, The Entrepreneurial State, Mariana Mazzucato looks at the lack of innovation and investment in research and development to notice that most corporations today have relied on the privatization of publicly funded innovation. Mariana suggests that the U.S. public, quote, do not realize that corporations are making more money from innovation that has been supported by their taxes, and these taxpayer-propped corporations are neither returning a significant portion of their profits back to the government, nor investing in new innovation. But the question is, how did we get here? So this concludes episode 2, part 1. I will have part 2 out very soon. Feel free to subscribe if you want to find out when part 2 comes out. Also feel free to check out the channel, my other videos that I have up. I will definitely have more coming soon, more periodically as well. Feel free to like and follow on any of the social media platforms. And thanks for watching, and welcome to Reconstruction.